4, 3, 2, 1, and welcome everybody to a new episode of Days of the Wolf, where we go into crypto tech and time travel news. This is your host, D Wolf, coming at you live from a secret location within the Northwest. Talking about the IRS new rules on cryptocurrency. It's a little bit of an old news story. Since October 9th, and let me switch it out so you can kind of see what I'm looking at. Display. Okay, the International Revenue Service, the IRS, just issued its first cryptocurrency tax guidance in 5 years. The U.S. International Revenue Service is a tax authority within the United States, and they've decided, quite a while ago, to consider cryptocurrency as a form of property. I think now this is not financial advice. I'm not an attorney or anything like that. I'm just going to kind of tell you what I've read on this. And I know there's a lot of people that don't like the IRS and thinks taxation is theft, which I'm inclined to agree with, at least with the aspect of income tax. I got my other friends on the other side of the pond saying, hey, if you want to live in a civilized society, you got to pay your taxes, and you need roads and schools and stuff like that. And to all that, I would say, yes, that is true. But I do not mind contributing to those things. But when it comes to like war and the industrial complex and just basically wasting money, I'm not really hip on that. But aside from that, the idea of their tax guidance, whether you're going to pay crypto taxes or whether you're not going to pay crypto taxes, that is completely up to the person involved. I personally don't make judgments on it. Everybody has their reasons, especially when their kind of ongoing thing is, well, if it's Caesar's coin, then you render unto Caesar. But if it's a coin that's just manufactured out of thin air, kind of like how fiat is, then, there's a little conflict there. But either way, I'm going to go over the news stories, and I'm going to kind of help explain a little bit on the details. Now, it says that involving with forks, resolving a long-standing question, the guidance says new cryptocurrencies created from a fork of an existing block should be treated as, quote-unquote, an ordinary income equal to the fair market value of the new cryptocurrency when it was received. So this means that you're getting an income for it, and it's registered as an income now. In other words, tax liabilities will apply when the new cryptocurrencies are recorded on the blockchain if a taxpayer actually has control over those coins and can spend them. The document said to continue to read, if your cryptocurrency went through a hard fork, but you did not receive any new cryptocurrency, whether through an airdrop, a distribution of cryptocurrency to multiple taxpayers' distributed ledger addresses. Now, this is very important that, they're tracing the addresses which this goes to, or some kind of other transfer, you don't have taxable income. Which makes it really confusing in the sense that, the very fact that they're taxing cryptocurrency in the first place just makes it crazy. But one of the things that I read about, which really is kind of a dangerous situation. Now, I'm going to switch it back here. It's a dangerous situation in the sense that one of the things about cryptocurrency is one unfortunate consequence is the guidance of third parties on how they can now create tax reporting obligations for you by simply forking a new network whose coins you own or by fostering an unwanted airdrop. Basically saying that if you receive an airdrop and you don't, just because your address is out there in public and someone gives you an airdrop, now you're responsible for saying, oh, okay, that's income that I received and stuff like that. Um, so it makes it more unwieldy for you to manage, creating the right repository to explain it and try to have the IRS, understand it. Like you're explaining, okay, how you got all this income, plus things that you maybe not won't be aware of. An unwanted airdrop could come on your public address. If you plugged your public address out there to receive coins, or like maybe on the bottom of your website for like a donation page or something similar, then you're obligated for that income, whether you're aware of it or not. And if the IRS detects that your wallet is affiliated with that, and if you've kind of demonstrated your public key, that could be a case, then they can get you for your taxes on that. So the major problem, and I'll come full circle with this, is that now all your one of the biggest problems is the IRS doesn't really have a full understanding of how to adapt to this cryptocurrency world. It's it's still kind of in the fiat world. It collects through a W 2, your social security number. It can tie all those things together, you know. But now the IRS has to go over and above that to figure out what wallets are actually attached to who, if that who is a tax citizen of their sovereign nation, and the actual thing to go after them. You know, they don't want to do their own. They can't do the same level of accounting that they can if you say earn a W 2 paycheck and stuff. And they can see how much you get paid because the employer has to write that amount, you know, that they pay and put it on their taxes. So they can see what the social security number, or if you're an LLC, a tax ID number, gets in revenue, and what the corresponding business or employer that they work for sends out in revenue. They can kind of manage that. But with cryptocurrency, unless they can tie the wallet to you personally, which they're really working hard to attempt to do. I mean, they reached out to several third-party agencies to try to figure out what addresses or what, you know, who they most likely belong to. If you implemented any KYC exchange, they can tether that directly, which is a problem with newbies trying to get into crypto and keeping your finances insulated from that. If you're writing your signature and writing your name on it, it really defeats the purpose of privacy and transaction, which is great for them but bad for you, because now people know that whatever wallet that you have is attached to your personal name, and you know, an astute hacker can can kind of infiltrate that, figure out who and what you're all about, and go after you even more, especially if there's amounts attached to your wallet. I've always hated the idea of KYC and AML, and the reason being is that now you can get people to see who owns particular wallets, and it's not so much that to keep you on the up and up and make sure that you're saying you are who you say you are type thing. It's now to a point where they can go, okay, now we have a name, now we have a number, now we can figure out more things about this person with this wallet. You know, where are their assets? Do they have houses? Do they have cars and stuff like that? That's just kind of how I think. But if you can keep your a wallet anonymous and insulated from that, then you can just buy things and sell things on the internet and not have to worry about, you know, people trying to infiltrate metadata attached to the wallet. But that's kind of the state of affairs right now. There's more on the article. I'm going to link it, and everybody else can kind of kind of gauge their idea. Anyway, this is D Wolf. I'm signing off, and you guys have a great Sunday.